And it's a real pleasure to be with you today. So the energy transition globally is it continues to develop and grow, and this move away from fossil fuels it's inevitable, it's remorseless. And this has profound consequences for countries that are producing fossil fuels. And I want to look at that in my presentation today, which is shareable. I'm very happy for anyone to receive it if they wish to have it. So can we go to the first slide? So Carbon Tracker, we're a non-profit financial think tank. We look at the financial and strategic implications of the energy transition. A lot of investors and bankers and regulators use our analysis. They assess corporate alignment, particularly of oil and gas companies and their investment plans, and we'll look at that in brief. And if we go on to the next slide. Yeah, thanks. Look, all of this is downloadable for free. Carbontracker.org. You can download all kinds of files on oil and gas companies and power and utility companies, and it's used by Climate Action 100. A lot of investors use it. So it's all a free resource funded by philanthropy. Next slide. So this is what I'm going to address. Because clean technology, the cleaner technologies around renewables, wind, solar, battery storage are so much more efficient now and increasingly reliable than fossil fuels. This is an unstoppable revolution. Next slide. And this is what it means. These are the key takeaway particularly for fossil fuel producing countries. The industry is facing an irreversible decline in demand because the new alternatives are substitutable for the old. Electric vehicles for the internal combustion engine and so on. Solar and batteries instead of gas-fired power. It's driven by policy action, even with the Trump regime, and it's driven by technology revolution. Lower demand typically means lower prices and lower demand that will in turn impact producer governments' revenues, regardless of their production costs, and all exporting countries are going to be affected. Most what you would call petrostates, countries dependent on oil and gas revenues, we see will face over 50% of revenue loss under a moderate-paced energy transition, and that fragile, by which I mean, countries highly dependent on oil and gas revenues, they need to diversify to avoid the worst impact on their economies. And then reductions in revenues, it's just going to increase country indebtedness unless they diversify and impact their creditworthiness. And that has quite significant implications for sovereign markets, for sovereign issuance of bonds or raising debt on the capital markets. Next. I've got to thank my good friends at Ember and Rocky Mountain for this. There's my old friend Kingsmill Bond, two visions of the energy future. There's the old guard, which possibly thinks that they're the new guard because they've been so politically vocal in the last 2 years, is this idea that energy demand, if it grows, it's going to be met primarily by fossil fuels, and that solar and wind will only dig into incremental demand. But then you've got the other delivered virtually its entire global energy needs in terms of capacity from new build solar. And last year, California, which is, if it was an economy, is the fourth largest economy in the world, dropped its gas use by 37% in 1 year. Now, if you apply that to other developed economies that can electrify, this will mean that there's going to be very major disruptions to demand for oil and gas in particular. Next. So capital has poured into this clean tech sector. I think all of you will have seen a slide, something along this. There's two parts to it. At the bottom is the electricity generation, clean power generation. That is dark blues from renewable energy. And on the other side is the use of historically of say fossil fuels. Now it's from electricity in cars. So you've got transportation, the purple quite significant. And then in grids, buildings, and all of this capital being deployed is growing fast. And now it's certainly in the United Kingdom, you've got a lot of renewable energy that is available that just can't get onto the grid because we don't have a grid system in the UK, and I think it's true across the world. We haven't invested enough in grids to take on this clean power. But as soon as we do, there's a lot of clean power that's going to come onto the grid next. Now I want to deal with this one. This is came out in a blog, and I kind of it was taken from Rhodium's group's research. There's this view that somehow a Trump administration will have slowed down clean technology spending as a percentage of overall US private investment. And they make the point that no, this isn't the case, that we've seen growing and increasing still the capital deployment into clean technology, despite all the policy headwinds we faced in the US. Next slide. And it was Al Gore that said, investors are waking up to the biggest opportunity in the history of the world. In economics, things take longer to happen than you think they will, and then they happen far faster than they thought that they could. And this is so true. All the forecasts and projections of the ramp up of clean energy, we've just blown through all those targets in the last decade. Those last 5 years have been so crucial, moving from 1 trillion to 2 trillion very, very quickly. So I think it took 20 years for the first trillion into clean technology. Then it's literally a matter of a few years before the second trillion. And I think the third trillion annually will only take a matter of a few more years. So all of this is growing exponentially next. Now, why is this happening? I don't think we should be surprised. It's the technology being solved, whether it's for the cost of batteries, the cost of EV manufacturer, the cost of offshore wind. All these costs, the more people want to buy, the more people that want to buy, the lower the costs, the more the take up. And I think it's Australia, and somebody correct me if I'm wrong, that's announced that as of the beginning of next year, every person in Australia will have 3 hours of free energy every day because they've built so much clean energy that's available, and they want consumers to start consuming this energy when there's a lot of energy availability. This cost down will transform everything, because if you think about it, you're moving oil and gas from one side of the world to the other. That's expensive. But if you're making energy in a location where you're using it, using battery storage, the cost just lower. And they keep getting lower. Next. Just another way of looking at the same thing. Again, this is the individual technologies. There you've got battery storage in brown at the top. That's the cost that keeps dropping. And the one that you're looking at is the comparison with gas. And once you get a solar plus batteries working together, or wind plus batteries working together, you can solve for a lot of problems. You can move production to closer to where the cheapest forms of energy are, and data centers as well. Next. Again, I want to thank my friends RMI and Ember for this. Technologies are beating commodities on speed. So along the bottom, you'll see coal, gas, and there's hydro as well, and nuclear. Look how many years it took, 35 years for the capacity to grow, to build a system that's based on fossil fuels. But look at solar, look at wind, and I mentioned Pakistan. I could have said Vietnam. I could have picked a country like Ethiopia. That there you're seeing the speed of deployment, and it's the rapid deployment, often built by, let's say it clearly, it's built by Japanese Chinese technologists and engineers. It's moving very, very fast. Next slide. And incumbents have underestimated the speed of change. I think all of you will have seen the slide on the chart on the left shows the world energy outlook from 2016, 18, 2020, 22, 23. Every year, the world energy outlook always underestimates the amount of capacity additions in gigawatts. And each year they far exceed what gets deployed, always exceeds the forecast. And the forecast is often, years behind. And you'll see the same around EV share of sales and battery sales. The same. You've got these S curve appearing in terms of adoption. Next slide. Solar and batteries are taking over. I think I made the point. Again, if you look at generation capacity on the left, it's now exceeding a capacity for coal and gas and hydro. And as that ramps up and as it works smartly together with battery storage, then you've got that constantly available power that the critics of new energy always say, oh, the sun doesn't shine at nights if somehow we hadn't noticed, or the wind doesn't always blow, as if somehow that has never been true. But once you get clean technologies operating with grid management and stabilization and demand management and battery storage, you're actually moving to a very, very efficient system. Next slide. So there we have it. My background and our audience at Carbon Track are investors and bankers, and what they want to look at is annualized growth figures. There's the annualized growth figures for wind, for solar, and for battery. Investors like to be in sectors that are growing faster than the market as a whole. If global energy demand is growing 1.5% per annum, it's these technologies that deploy at scale and at speed that as an investor, an infrastructure investor, is looking to get an exposure to. Next slide. And as we electrify everything, it's the rest of the system as well, whether it's heat pumps, cars. The one that sort of surprises everybody is heavy trucks. Look at the numbers of hundreds of thousands of heavy trucks in China are now electrifying. And whether it's electric bicycles or electric motorbikes, or in India, the electric tuk-tuk, the three-wheelers, it's all electrifying very rapidly. A friend of mine just returned from Addis Ababa in Ethiopia, where the Chinese have built whole transportation systems where they've built in electrification for transport, including all of the powering systems. It's an extraordinary change. The global south is leapfrogging the global north and going straight to electrification. Next slide. And look, let's be frank, Europe is getting crushed by the ability of the Chinese to deliver super, super cheap systems to the rest of the world, particularly the global south. There's a number of reasons for this. Part of it is to bump off the dollar-based petro economy, to undermine the dollar as the reserve currency and replace it with the renminbi, or at least to dilute the power of the dollar economy. And China has become the first major electrostate. They've decided this is a sector that they can win, and they've done that very persuasively, very aggressively. Europe is being squeezed. America is reverting back to fossil fuels to hold out, but I think this is unstoppable. I wouldn't wish the Chinese system on anybody, but it seems to be unstoppable. Next, please. And this is the world's largest energy consumer. If you look at the number of patents that are being claimed for clean energy, China leads. Battery manufacturing capacity, renewable energy capital deployment, and electrification leaping ahead of Europe and the US. And as we know, the costs are dropping fast. You build a system based on free wind and free solar. Once you pay the capital costs of your technology, the marginal cost of energy drops and trends towards zero. As your energy costs drop, that gives a huge competitive advantage. Europe and the US still think that importing expensive fossil fuels is competitive. I think that this system is, it's a one-way street. Next slide. Now, I mentioned it before. I think we should look closely at this. China's solar panel exports to the global south in red are more than doubling every couple of years, to the point where, they're exceeding exports to the global north. And again, I think this is partly economic. Yes, it's partly political, to get access to raw materials from the global south, to access to growing economies in the global south, led by China giving the world super cheap transport and energy systems. Again, unstoppable, deeply political, good for the environment, and good for the economies using this clean technology. Next slide. China, I've got to say it again, the manufacturing hub of the transition. China dominates manufacturing of the key energy technologies of the future, whether it's solar. There it is in red, looking at red right across this: wind, batteries, electrolyzers. And heat pumps, well, heat pumps, the Germans, the French are pretty good at making heat pumps. So is the US, but for all the other key technologies, again, it's China. Next slide. Well, I think the UK, Europe is up to 25% of new vehicle sales are electric vehicles. And when I first heard that China is manufacturing cars at a list price of $8,000 to $10,000, Europe just can't make cars that cheap. And now in China, in the middle of last year, new energy vehicles top 50% of all Chinese car sales for the first time, and that continues to grow. Other parts of the world, Norway, Nepal, these countries are the figures are far higher, 80%, 90%. Next slide. Next slide. Now, the internal combustion engine, this is a problem for European manufacturers, peaked 2018. And from that point onwards, the sale of internal combustion engine has dropped by about 20%. So from around 80 million to 60 million and further below than that today. So you've got electric cars taking the growth, very, very significant. And when you've got BYD coming in with super cheap cars, it's just irresistible to consumers. If you can run it cheaply, operate it cheaply, maintain it cheaply, power your car at home in the middle of the night when electricity is very cheap. It's just, this is again unstoppable technology. And we don't even need to have everyone having electric cars. We've got car sharing, we've got buses, and so on. Next slide, please. Look, what is this all pointing to? It's demand destruction for oil and gas. And this is the sensitivity that investors are looking at. During COVID, global oil demand fell from 101 million barrels of oil demand a day. It dropped by about 5 million barrels a day during COVID. Oil prices went down to $10 a barrel. Now, we know that if your production costs are $40 a barrel, $40 a barrel, where it depends on where you are, if you're selling at 10, that's negative return. And that's why the share prices of the oil majors dropped. And the International Energy Agency is forecasting that at the continued growth in electric vehicles, we could see 5 million barrels of oil demand disappear by 2030. Now, what you're looking at here along the bottom, 2023 data, is the different International Energy Association scenarios, the stated policy scenario, the announced policy scenarios, the net zero scenario, and the amount of oil displacement that would happen regionally. So you've got Japan there in the purple, Europe in the blue, China in the red. No, it's the rest of the world, sorry, in purple. The United States is in green. So you've got significant potential demand destruction. And I'll come on to the significance of this in a minute. As a rough rule of thumb, correct me if I'm wrong in the chat box, about 20 million electric vehicles kills about 1 million barrels of oil demand a day. So the more electric vehicles on the road, the lower oil demand. Of course, oil is used for other things, but that's the rough rule of thumb. Next slide. So what does this mean for oil and gas? Well, it's inevitable decline. Today's Financial Times has a whole page about Shell and BP, where even Ben Van Buren, the ex-CEO of Shell, talks about the inevitable decline and disappearance of the oil and gas sector. Next slide. Thank you. So the risk that we look at Carbon Tracker, we study the investment plans, and the risk of overinvestment is very real. The fact that companies may approve projects, expensive projects. We're just looking at Canada. I've just come back from Canada, building pipelines and building LNG to export into the world market in 5 or 10 years' time, a market that may have disappeared by the time that they built that infrastructure, the stranded assets problem. Next slide. So now this isn't entirely accurate because it's slightly outdated, but I think it just illustrates the point that we're making, that not all oil and gas projects, as we know, are the same. You've got low-cost producers on the bottom there on the left. You've got high-cost producers like the old Kashagan project up there on the right-hand side of the supply curve, and that essentially what the person, this was a Bloomberg picture, what they did is they took the then oil price, it's a bit lower than that today, 60, 62, at the $70 oil price, you can see there's most potential projects are out of the money unless the oil price is back up at $80, $90 a barrel. And there's a lot of production still below that, but look at how much production disappears when oil prices get below to say $30, $40 a barrel. Next. This is another way of looking at the same slide, but this is done intersecting from a climate point of view, different warming outcomes. So you've got the stated policies marginal break even at $65 a barrel. Then you've got the announced policies marginal break even at $40 a barrel, and we've intersected the curve with those two in yellow, and then the first one announced policies. We've intersected it because you can then align that with different warming outcomes. So APS is roughly 1.7 degrees of warming. STEPS is roughly 2.3, 2.4 degrees of warming. So you can see how much future supply needs to disappear, which is in the red and in the blue, to get back around 1.7 degrees of warming against pre-industrial levels. So the well below 2 degrees of the Paris Agreement. Next slide. So what we then did, and this is our Paris Maligned report that's based on Rystad data. Again, you can download it for free off Carbon Tracker's website. Listed companies could potentially spend $1 trillion on what we describe as unneeded assets, where there's a risk of financial stranding. We applied this cost curve approach to find which capex is most at risk. And what you're looking at there in the red and the blue and the yellow is in the red, you've got your stated policy scenario that's up at 2.3, 2.4. And then you've got your announced outside the sustainable development scenario, inside the stated policy scenario in the orange. So remember, this is future potential capex, not projects today, but projects where there's optionality. And what you can see from this, look at how many companies have the potential to approve projects which take us way up above the goals of the Paris Agreement. There's an awful lot of unneeded potential production if we want to keep to the goals of the Paris Agreement. I'm going to dig into this because there's a paradox in here, which I'm going to go into in another slide. Next one. Okay, it's this one. I don't know how many of you have seen this. This was published by Goldman Sachs. It reappeared in the Financial Times a couple of weeks ago. And what you're looking there, in 2013, which is roughly when Carbon Tracker got going, the average reserves life of the European majors, BP, Total, Eni, and Shell, was up at around 12 to 14 years. Because of a collapse in investment, reserves life of the oil, the one that surprises a lot of people, BP, is down to its last 6 years, 6.5 years of P1 reserves, the reserves that the market looks at and tries to base a future cash flow on. And Shell is about 8 years. Now we hear that BP is going to be investing more, but the story is of a lack of the replacement of depleted reserves from the being sold. This is an industry that's in contraction, but we don't really talk about it. Now, why is it a paradox? There's so much optionality these companies have to do projects. They're just not doing the projects. So something curious is going on. And why this is important is companies like Total are issuing 30-year bonds on the bond market. BP and Shell alone have $100 billion of bonds. How are they going to pay the coupons on the bonds and repay the bonds if they're out of reserves in 6-7 years and not replacing it? So what is that telling the financial markets, particularly the bond markets? The bond markets are buying 30-year dated paper with no evidence that these companies can actually fund their capital repayments. We've talked to regulators. Regulators say, oh, these companies must be becoming renewable energy companies, which of course they're not. How are they going to pay back their debt? How are they going to fund the coupons? How are they going to fund their capex? How are they going to fund their decommissioning liabilities? Very interesting. If anyone knows the answer to that, email me at mark@carbontracker.org because I don't know the answer to this paradox. Next one. And so this tells part of the story. So in blue, it's a percentage of this came from, I think, Goldman. Yes, it came from Goldman Sachs. The percentage of free cash flow distributed on new capital expenditure. So if you look at the blue, it pretty much kept up, peaked in 2016, and then it dropped. It dropped. And the money's been spent on repaying debt in the yellow and dividends plus share buybacks. Tiny sliver on low carbon capex. BP's down to what, 300 million on non-oil and gas capex this year. So it's going back into share buybacks. So this is an industry which is in contraction. Next slide. Okay, some wrap-up conclusions, and maybe we'll have some Q&A, but let's go through some conclusions, please. So if you imagine that you're on the board of Shell or you're on the board of Eni or Total, and you've got to think to yourself, what are you going to do? And let's say there's no one-size-fits-all strategy. You could do what we think is happening, which is manage decline, returning capital to shareholders, dividends, share buybacks. And on the other side, renewable electricity generation. That's a very different model. Carbon capture. Where's the financial model for that? Chemicals. Do we believe in the demand for chemicals or biofuels? Next slide. Now, we see on one side, on the left, an acceptance of the transition. The most obvious one is Ørsted. And then all the way onto the right, an expectation of more business as usual, continued growth and demand for oil and gas. And there you've got a very different strategy, new developments, new exploration, managed investments. And so you've got a whole range of possibilities if you're on the board. And just look at the battles at Shell and BP in the last year, 2 years. There's a lot of schizophrenia amongst the Europeans as to what they should do compared to, say, the Americans, which are back to, defending their old business model. Next slide. So we see flashing red lights all over the fossil fuel system in terms of capacity additions or oil and gas capex, or the sales, which we know are dropping of internal combustion engine, or even demand scenarios, kilojoules per capita wavering. Next slide. So again, it goes to the heart of what we do at Carbon Tracker is this overcapacity creates price shocks where you may build assets, infrastructure, pipeline, but never get the return on capital that you anticipated. And in Carbon Tracking, we wrote a report called The Size and Decline of the Fossil Fuel System, written by Kingsmill Bond. We estimated there's around $50 trillion of fixed assets. It's the largest fixed asset system in the world. We're going to have to lose about half of that in the next decade. Are the companies preparing for asset write-downs? No, they're not, which is why we look at the accounts. But the potential for price shocks to the system as demand falls is very significant indeed. Would it be a problem for governments? It's a problem for the banks. It's a problem for the companies and their shareholders. Next slide. Fossil fuel demand, as we model it, sees inevitable decline. The question is the length of the plateau. Is it going to be a short plateau or a long plateau? We'll know in the next few years, particularly with AI installation taking up a lot of capacity. But can we beat and exceed by installation far faster than AI can grow demand? Next slide. Yeah, thanks. Now, I started off the presentation talking about country level risks at the country level. And what we've done here is look at a percentage of revenues, oil and gas revenues as a percentage of total petrostate revenue. At the top there, you've got Venezuela. How long will it be around? I think it's a very different place in the cover. Iraq, obviously, Algeria, many of the other economies. Nearly half derive over 40% of total government revenue from oil and gas, and are particularly vulnerable, particularly the lesser developed countries, Angola, Nigeria, and so on. And it's the lack of the ability of these economies to diversify that there's the problem. Next slide. And national oil companies should really question the viability of future investment because they're not the lowest cost producers. Now, many of the countries are low cost producers. The Saudis are a good example of that. So they will probably survive and benefit much better than other economies. So this again looks at unsanctioned production as a percentage of the stated policy scenario production. And you can see like Pemex and others, look how exposed they are. And the transition is going to be very destructive to long-term cash flows. There's going to be a lot of restructuring that's going to need to be done in these economies unless they can diversify and find other sources of revenue growth. I mean, even in the UK, we're not a petrostate any longer. We're getting 25 billion sterling a year from fuel excise duty. That's going to collapse as electrification of the vehicle fleet grows. How are governments going to replace their revenues from something as simple as, the tax of the pump from everybody filling their car with petrol? Big problems for government revenues. Next slide. So there's an executive summary. I'm not going to go through the executive summary. There's some headlines. The fossil fuel system, inexorable decline. Please read afterwards. So charges being led by China, we know that. Red flags across the fossil fuel system. A lots to explore here, but thanks very much for inviting me to this present to this webinar. And if there are questions, very happy to see if I can answer them. And for those trying to follow in Italian, I'm sorry if my English was too sorry if my English was too fast.